Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 5, Bank Accounts. One of the first financial decisions most people make is choosing where to open a checking and savings account. Although I'd point out that the term checking account is a bit of an anachronism, as most people don't write very many physical checks anymore. Perhaps a better term would be spending account. And in fact, that's what some banks, like Ally Bank, call it. So I'll refer to checking accounts as spending accounts for the rest of this podcast. Most folks are using whatever bank or credit union they started with, sometimes because that's the one their parents used, or sometimes because they got a free t-shirt or frisbee when they signed up in college. They really haven't ever looked closely at what their bank offers or comparison shopped for what other banks offer. While this is not the financial decision that will have the largest impact on their overall financial well-being, it is a fairly easy one to make and will make a meaningful difference. The problem with many banks and credit unions, but I'll just use the term banks to keep it simple, is a combination of paying very low or no interest on deposits and then charging fees for various services. Most folks just see this as the cost of doing business, or more likely, don't really see it at all. While it's true that banks need and deserve to make money for the services they provide, the question is, how much do they need to make, and do you really want to be leaving them a large tip on a monthly basis? You give your money to your bank, and they provide you some services to help you manage that money. But they also then take your money and loan it out to people, sometimes even to you. And they charge interest when they loan that money out. So you are essentially loaning your bank your money. Most people don't think about it this way, but it's true. And just like banks charge interest when they loan out money, you should be charging your bank interest when you loan them your money. This is why most banks pay some kind of interest, occasionally on spending accounts, and usually on savings or money market accounts. The problem arises if your bank is paying you below market interest rates on the money you are loaning them, and if they're charging you extra fees that aren't really necessary. There are lots of good choices of banks or credit unions, depending on where you live and where you work. But here are the non-negotiables. Your checking, spending, account should be free with no fees or minimum balance just for having the account open. It's okay if it requires a direct deposit because you should be having your paycheck direct deposited into the account. Ideally, your spending account would also earn a little interest. Your savings account also needs to be free with no fees and no minimum balance, and it should earn interest that is competitive with the other choices that are out there. If you're not sure if your current bank accounts meet these criteria, look into it. The first step is to figure out what interest rate your current spending and savings accounts are paying, as well as any regular fees such as monthly service fees, overdraft charges, or charging you when you order new checks. While most spending accounts pay little or no interest, there's often quite a discrepancy between what your bank is paying you for your savings account and what some other banks are paying. These other banks often offer what are referred to as high-yield savings accounts, and many people are unaware that their current bank is taking advantage of them by not offering an interest rate that is competitive with these high-yield savings accounts. Most of the banks that offer high-yield savings accounts also offer at least a minimal amount of interest on their spending accounts. And they don't have monthly service charges or overdraft fees. And they usually offer automatic transfers from your savings account to cover any accidental overdrafts. They often even offer free checks for those occasional times you still might write a physical check. Whenever I discuss this, there are a variety of excuses, people typically list for why they haven't switched banks. Here are some of the ones I hear most often. I've been with them for 20 years. Okay, so inertia. Even the folks who say this realize this really isn't a good reason. I also have credit cards and loans with them that I like and want to keep. Well, first, very few banks require you to have a spending or savings account with them to get a credit card or a loan for them. And second, you likely can get a better credit card and a better loan elsewhere. Loyalty. I've been with them for 20 years and they've always been there for me. This is one of the most interesting ones to me. While it's true that they've been there for you for 20 years, that's often because they have been profiting from you, taking advantage of you, for 20 years. And I'm curious whether these folks think the bank is going to be loyal to them. What do they think will happen if they go to their bank and say, I'm having a bit of a rough spot. Is it okay if I stop paying on my credit cards and loans for the next year and you won't charge me any interest or late fees? Sure. Very unlikely. Community. My bank sponsors the local Little League. Okay, that's fine. But what you need to realize is that they are not sponsoring the local Little League team. You are. They are overcharging you for their services, especially by paying below market interest rates, taking a small amount of that to donate to local organizations, and then the rest goes to their bottom line. Instead, you could take your business elsewhere and then write a check to your local Little League, and both you and Little League will be in better shape. It's too much of a hassle to switch. Well, there's pretty much no hassle to switching your savings account. It should take you less than 10 minutes. There is some work involved to switch your spending account, but let's look at that a bit more carefully. It should take you between 3 and 5 minutes to switch each direct deposit or auto pay you have set up. Once you've opened up your new, better spending and savings account, have the routing number and account number for your new account copied into a document so you can quickly copy and paste them. Then work your way through each of your direct deposits and auto pays. Even if you have 30 of those, that still will only take about 2 hours. And while the interest rate payoff from switching your spending account might not be that great, the real value, in addition to avoiding any ticky-tack fees your current bank might be charging, is the ability to instantaneously transfer between your spending and savings accounts, as well as automatic overdraft transfers. This instantaneous transfer allows most people to keep more in their savings accounts than they typically have because they know they can instantly move it to their spending account if they need it. As a result, they end up earning more interest. A tortured analogy I sometimes use is to ask people to imagine there's an intersection where there's a gas station on each corner, and this is where you usually stop for gas. The 4 gas stations all sell the same gas and all offer the same conveniences of overpriced snacks, soft drinks, and cigarettes. But interestingly, at this particular intersection, there's a fairly large deviation in the prices they charge per gallon of gas. As an example, let's assume the least expensive station, Ally Bank, is charging $3.50 a gallon. But on another corner, there's a station, Wells Fargo, that is charging $84 a gallon. And on the other 2 corners, the stations, Bank of America and Chase, are charging $1,260 a gallon. I think we know which gas station you would likely choose to use. But it's even worse than this, because some of these gas stations also charge you extra if you want to put air in your tires, overdraft fee, or use their windshield wiper fluid and paper towels to clean your windshield, ordering checks or a debit card, or even an entrance fee just to drive into their parking lot, account maintenance fees. So we are going to complete an exercise where we compare your existing bank accounts with some alternatives and see what your loyalty might be costing you. Before we head to the spreadsheet, we need to spend a moment discussing how much money you should keep in your savings account. To be clear, this is going to vary tremendously based on your individual financial situation as well as your personal comfort level. But here are some basic guidelines. Conventional wisdom is that you should keep anywhere between 3 months and 12 months of expenses in your savings account, depending on a variety of factors, including how secure your employment and income are. This often also includes money for your emergency savings, but I'm going to encourage you not to use the term emergency savings anymore. I think the word emergency in emergency savings is both misleading and perhaps leads to less than optimal outcomes. Savings, by definition, is money you set aside for possible short-term needs. Lots of folks interpret this as being for an upcoming bill that you know is coming due, or perhaps for an upcoming relatively large purchase that you know you can't pay for out of your regular cash flow. To me, the former is definitely not savings, as you've already spent the money, or at least committed to the liability. It's more like delayed payment. The latter can indeed be thought of as savings, but again, It's designated for a specific future purchase, so, in some ways at least, it's also just delayed payment, or delayed spending, if you'd prefer. I definitely encourage folks to have money set aside for these. But also in your savings account should be money for those not so unexpected expenses that arise. And this is where I feel like the current terminology is perhaps a cognitive barrier for some people. These are not emergencies. These are expected expenses and should be part of your expected long-term cash flow. From my point of view, emergencies are things that are both truly unexpected as well as large enough that you can't pay for it out of current cash flow. Items like car repair, home maintenance, routine healthcare costs, and the regular costs of raising children are not unexpected expenses. They are not emergencies. Only perhaps the exact timing is unexpected. If you can pay for something out of savings that you have set aside from your current cash flow, then it's not an emergency, it's an expense. A true emergency is something where you have to make some kind of fairly significant adjustments to your lifestyle and or pull from your long-term investments in order to handle that emergency. Think long-term unemployment or disability or some major health condition that not only increases your expenses but decreases your ability to earn an income. It may just be semantics for some folks, but to me, words matter. And when you label common and expected expenses as emergencies, you aren't doing justice to the word emergency. By grouping true emergencies with the normal expenses of living, you are deceiving yourself as to the level of lifestyle that you can afford. It's very difficult for all but the wealthiest of us to financially plan for an emergency, but we should all be able to plan for the reasonable and expected expenses associated with our lifestyle. So, for all the expected expenses we have, including a bill that we know is coming up, a future purchase we are planning on, or the expected expenses that you can easily envision based on the lifestyle you are choosing to live, let's just call the money we set aside for that savings. You should be able to fund and maintain those savings using your regular cash flow, the difference between your current income and your current bills. So, now that I got that rant out of the way, how much money should you keep in your savings? That will depend on your individual financial situation, but a good estimate is to go back to the When Can I Retire calculator exercise we completed in episode 2. If you look back at your notes, you should be able to see what your current expenses are. The calculator lists your annual expenses, so divide by 12 to get your monthly expenses. For the example numbers I used in episode 2, the annual expense figure was $70,000, so the monthly amount would be $5,833, $70,000 divided by 12. I would then multiply that by the number of months of expenses that I want to keep in savings, likely somewhere between the 3 months and the 12 months that conventional wisdom recommends. I'll choose 6 months as kind of a middle ground. So if I multiply $5,833 by 6, I would need to keep about $35,000 in my savings account. You need to do the calculations for yourself, so your number will be different. Another number to gather before we go to the spreadsheet is your average daily balance in your spending account. Many banks give you this information on your statement or if you log into your account. If so, great, make a note of it. If not, a good proxy is to take the balance of your spending account when it's at its highest, typically right after your paycheck is deposited, and average it with the balance when it's at its lowest, typically right before your paycheck is deposited. As an example, let's say your spending account typically maxes out at $10,000 and bottoms out at $2,000. In that case, the average would be $6,000, and that's the number you would want to use for this exercise. Finally, gather the current interest rate, if any, you are earning on both your spending account and on your savings or money market account at your current bank. In this exercise, I'm going to use 3 high-yield banks or brokerages for comparison purposes: Ally Bank, Fidelity's cash management account, and Vanguard's money market account. I'll also include Chase Bank as a not-so-high-yield comparison. Please note that there are additional good choices available other than Ally, Fidelity, and Vanguard. I've just chosen them as representative samples. Open this Google spreadsheet by typing in the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. In cell B1, put your average daily spending account balance. I've put in $6,000 as an example. In cell B2, put your desired optimal savings account balance. I've put in $35,000 as an example. In cell B5, put in the interest rate your current spending account earns as a percent. If you have a tiered interest rate, put in the lowest tier. In cell B6, put in the interest your current savings or money market account earns as a percent. If you have a tiered interest rate, again, put in the lowest tier. In cell B7, put any regular monthly fees you are charged. These could include account maintenance fees, as well as fees for ordering checks or a debit card or something similar. For any fee that is not monthly, make sure you prorate it to the monthly amount. In cell B9, put in your assumed rate of return. I've again defaulted this to 7%. In cell B10, put in the number of years you're going to invest this money with a default of 30. As mentioned in previous episodes, I would leave this at least 30 and perhaps make it even higher. In columns C through F are the 4 additional banks and brokerages I've included as examples to compare to. Chase is a traditional bank offering the usual array of services. Ally is also a traditional bank, but is an online-only high-yield savings bank that also offers traditional services, but they pay a small amount of interest on their spending account and market competitive interest on their savings and money market accounts. Fidelity is a brokerage, but they offer their cash management account, which combines your spending and savings account into one. The advantage is that you earn a competitive high interest rate on your combined spending and savings since they are included in one account. Vanguard is also a brokerage, and they don't currently offer a spending account where you can write physical checks. But their money market account is a great account to use for your savings account, so I've included it here as a comparison. Note that for both Fidelity and Vanguard, a portion of that interest is also exempt from state taxes. The amount changes each year, but is typically higher than 50%. So if you live in a state with a state income tax, this will increase your net return even more. Row 8 then calculates the annual interest you'll earn in each of the bank accounts. With my sample numbers, that's $4 for Chase, $1,266 for Ally, $1,656 for Fidelity, and $1,481 for Vanguard. Row 12 then calculates how much money you would have after X number of years, with the default being 30, in each of these 5 accounts, including yours once you put in the information, if you invested your interest earnings monthly. With the sample numbers I chose, you can see that after 30 years, I would have $356 in Chase, over $128,000 in Ally, over $168,000 in Fidelity, and over $150,000 in Vanguard, simply by investing the increased amount of interest I would earn each month for 30 years. I think most people would agree that these numbers are significant and probably worth the 2 or so hours it will take you to change over. If you are taking notes throughout this course, take a screenshot of your completed spreadsheet and add it to your notes for reference. I'd also suggest adding a link to your copy of the spreadsheet so that you can return to it if you want to. Then perhaps write a paragraph or 2 or more reflection on this exercise, summarizing your current thinking about bank accounts. Does this motivate you to make a change? If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. In our next episode, we'll talk about making the most of your employer benefits. Many people are losing out on thousands of dollars each year by not fully utilizing the benefits they have available to them.